Hello friends, this is Raj Sastri from Raj Option Trading. Today is Jan 7, 2022. Let's talk about Carvana. Carvana is a car vending machine. As many of you know, their mission is to change the way people buy and sell cars. So as you can see here, you got a Carvana truck taking a car here. It's a very good business to be in. Let's jump in and look at Carvana and see if it's worth buying this stock here. So as you can look through here, we'll talk about company overview, competitive landscape, review few charts, look at the financial summary and stock performance, also rank Carvana with its peers and do a final verdict. So with that, let's jump in. So let's first take a look at competitive landscape. So as you look through here, we got Carvana and its industry peers. I've sorted this by performance here. As you can see here, companies with nice one-year performance are at the top and it's in the descending order. The first company here, which is ACV Auction, has no one-year performance yet. It's a relatively new company. As you scan through this here, we got ACV Auction to begin with. It's a new company, don't have too much fundamentals yet. We'll wait for it to settle down a little bit and then go from there. Next, we got PAG here, Penske. Penske is a very good company, as you can see here. Nice one-year sales growth as well as quarter-over-quarter sales growth. It's a money-making business here. Net margin is 4%, and they got some debt-to-equity ratio, very much manageable, not a big deal at all. And company has been doing well in 1 year. I mean, 1 day, 5 day, 1 month, 1 year as well as 5 years. It's a good business to be in. PAX is doing a good job here. Next up, we got AutoNation here. AutoNation is also doing well, as you can see here. This company has got nice sales growth, 1 year, quarter over quarter, as well as a good net margin here. Also, it carries a debt here. Typically, all these auto companies, they do carry some debt because they have to manage their inventory and turn it around. And AutoNation has got a little bit higher short ratio, as you can see here, and it's been performing well in 1 year as well as 5 years. I think it's a pretty good business to be in here. And next we got cost.com. I know many of you have seen the advertisements for cost.com. This is also good from a sales perspective. There is a sales growth here, and there is also net profit margin 3%. And company is relatively new, as you can see here, just 41% in 1 year. Not too bad. And then as you scan through, we got a couple more companies. Couple companies are really good here. I like CPRT here, which is doing great, as you can see here. Nice profit and nice net margin here. Company is making very good amount of money, as you can see here. And I also like Car Gurus here. They're also doing pretty good here. Also nice net margin, as you can see here. That's also a good company to be in. And finally, we got LAD here, one of my favorite. This is also doing great, as you can see here. Lithium Motors is a good one, and they're also making money. Net margin positive company. And finally, we have the company that we are talking about, Carvana here. Carvana, as you can see here, their top line is growing nicely. As you can see here, nice 95% 1 year, 125% quarter over quarter. They're also making good gross margin. But company is not making money. They're losing money. Net margin is negative 1%. And one thing I don't like about Carvana is a huge debt load here. Look, 10.2 debt to equity ratio. That's a big no-no for me. I think they have to reduce their debt load here. And company has been not doing great in last 1 year. They lost about 25%, as you can see here. And company is a little bit struggling at this point here. We got to be a little bit careful. We'll deep dive into this company and go into a little more detail. So with that, what we'll do now is we'll go into this company into a little more detail and look at the business and see what we can make out. So as we scan through here, we'll review a few charts from Thinkorswim platform and go from there. From a chart perspective here, we got Carvana, as you can see here. Look what's going on off late. It's been going down, down, down. So off late, recently, as you can see here, stock has been down big time. Look here, there's a huge drop, as you can see here. So right now, Wall Street does not like money losing companies, and Carvana is losing money right now. and it's got a high debt load. That's what is going on here. So it's because of its high debt load and the negative net margin, and these folks are also spending a lot of money expanding their business. That's why Wall Street is not liking it. Since the last 2 quarters, as you can see here, companies are struggling, since last 2 quarters. So we got to be watching this carefully. And as as you look through here, their on the balance volume is also dropping here. That tells you there is more selling. There is more selling going on here, and more sellers than buyers. And next we got PAG here, Penske. As you look through here, this company is a little more stable. Look, it's doing pretty okay here. It's in the tight trading range. But look, on the balance volume is going higher. That tells you there are more buyers than sellers. This is a little more manageable here, instead of Carvana. And then we got AutoNation here. AutoNation is also a pretty good company, as you see here. It's also in the trading range here, trying to bounce off of its 200-day moving average. At the same time, keep watching on the balance volume. There are more buyers than sellers. That's why on the balance volume is going higher. And then you got cost.com, a little more choppy, as you can see here. Probably this is a very very big short squeeze here. Stock went up after the quarterly earning. Now it's struggling, as you can see here. So it's a little bit low price stock, $16, as you can see here. And on the balance volume is kind of trying to go higher after the big drop here. I would probably hold on to this one here. There are better operators here. As you can see here, both PAG here is a good one, and we got AutoNation, also a good one. You could buy these companies in the downturn, on the pullback, and take it from there. So with that, let's jump in here and look at a few more companies. So now we got CarMax. CarMax is also a good operator. Look, stock is dropping here, big time drop, as you can see here. And on the balance volume is holding pretty much okay, even though there is a small drop here. It's relatively flat, as you can see here. I think this is a good one. You could buy slowly into this weakness here, given RSI is just 28. That tells you stock is completely sold off here. And then we got here Car Guru. It's one of the formidable competitor to Carvana here. Look, this also came down drastically, as you can see here. Stock has dropped. And look, even though stock has dropped, look at the on the balance volume, it's rising. So that's why it's a better play here. You could buy some Car Guru here, given RSI is very low here, just 36 here. And then you got Lithia Motors, as you can see here. Lithia also dropped big time, but look what's happening to on the balance volume going higher. So this is a much better play here. And look, stock is also going higher in the short term here. So I would also take a look at Lithia Motors here, which is a better play. And then you got ABG here. As you look through ABG, stock has fallen down, but now it's going higher. On the balance volume is also going higher. So this is also a solid operator. You could look at this one also. So with that, what we'll do is we'll look into a little more details and look at Carvana's background. As you look through here, Carvana's mission is to help people and change the way they buy cars. I think that's a very lofty goal here. I think people are really not happy about their car buying experience many times. This company is poised to change that car buying experience. So with that, let's jump in here and look at few statistics here. From a statistics perspective, as you can see here, they're doing pretty well in the car vending business here. And they're doing much better. As you can see, they got nice total markets that's doing pretty well from a revenue perspective and car vending perspective. And total units sold is also going at a pretty good clip. As you can see here, there's a 74% growth year over year. And gross profit is it was doing well in the beginning, but look what's happening off late. It's tapering off here. This is what we got to watch out for. Wall Street does not like these type of tapering off in the gross profit. That's why it's struggling a little bit here. And then you got we got some more statistics, as you can see here. Car vending machines, and as you see here, this is also plateauing here. So we got to be watching this carefully. And total revenue, after jumping big time here, Now it's kind of dropping off and solidifying a little bit. So this is also a big no-no for Wall Street. And finally, EBITDA margin, after improving a little bit, now it's going down south here. Wall Street does not like this also. So in a nutshell, by looking at this picture here, you can make out, even though they're growing their top line nicely, indicated by the numbers here, but the bottom line, when it comes to the profit, the margin, and the revenue, it's not going at the same clip here. That's why we got to be a little bit careful on this company. We'll jump into a little more detail. So with that, let's jump in here. So as you look through the company background here, look, it's a car vending machine. As you can see here, it's for buying and selling used cars in United States. They have a good platform here. Stock price is around 191 here. Even today they dropped off a little bit, and market cap is around $33 billion. And looking at the stock performance here, stock is dropping off big time, as you can see here. Since June or so, it's been dropping. Probably from August onwards, it's dropping. And right now, analysts are saying moderate buy, as you can see here. We got 8 analysts here with the buy rating and 4 hold rating, as you can see here. And also, folks are wondering here, is it time to sell Carvana? According to Insider Monkey, they're thinking through here. And, CarMax gains, as you can see here. Competitors are doing well. And options market is signaling something about Carvana here. We can look at that in a little more details as we go through with the details. So with that, overall, you can see a company that's doing well from a top line, struggling in this Wall Street, right now, with all the stock rotating out of growth into more stable names with the real profit. So that's what's going on here. That's the reason for the big, huge drop here. So with that, let's jump in here. As you look through here from an analyst projection perspective, stock price is around 190 or so right now. Analysts are projecting stock will go higher, as you can see here. They are thinking it will go up to 260, low target 354 or 425. I think this is a little bit higher valuation for this company, especially right now Wall Street does not have patience for companies like Carvana with the negative net margin. So that's what's going on here. Companies losing money. The price target from the analysts are higher here. I think it's a little higher here, a little more lofty. So I'm not buying this price target, given it's too high, and Wall Street does not have patience right now for stocks like Carvana, but it could be a good one to buy slowly on the dips. We'll jump into a little more details. As you look through the leadership here, I like Ernie Garcia. He's a great CEO. And as you look through here, there are 82% of the employees approve the CEO here. That's a very good rating here. So the CEO is doing something right. He knows this business very well. He co-founded Carvana, as you can see here, and he's been president and CEO since 2012 here. As you look through here, he had been in the auto industry for a long time. So he was with the Drive Time before, Drive Time Automotive Group, and he was also with the he was also a financial strategist before, and he was a qualitative analyst. He was the director of qualitative analytics. Looks like he's got enough background here, so I think he's the right guy for the job. So that makes CEO checks out. He's got the right mission and right inspiration to take this company forward. So with that, let's jump in here and look at a few more details. As you look here, we got the exposure in the ETF market. Look, there are big ETFs buying this company. We got BUYZ here, Franklin Disruptive Commerce, nice 506K here. They have 506,000 worth Carvana shares. But look, there are bigger ones here. We got Goldman Sachs Hedge here. They have about 3.69 million. And we got iBuy here. They got a huge 8.78 million worth shares here. And look, there are a few more, as you can see here, with the high amount of shares in Carvana. So in a nutshell, we got a lot of these ETFs buying Carvana and holding them. That indicates there is some good confidence level in Carvana in many of these names here. Look, we got Russell Mid Cap Growth ETF that's holding a huge 72 million worth, in Carvana here. So there is a lot of ownership from an ETF perspective. So the company is not going to go away anytime soon. I think it's got good coverage and support from these ETFs. So with that, let's jump in here. Look at the do a quick deep dive on Carvana. As you can see here, Carvana, I think they're doing not so great from a earnings per share perspective. As you can see here, it's kind of trending down in the different direction here. This is one thing I want them to improve. Typically early stage companies do they don't want to show earnings yet because they want to solidify and scale their operations. That's what's going on here. And look, from a sales perspective, this company is doing something right. They're growing their top line pretty nicely, as you can see here. That's a good clip here. On the other hand, look, we got shares outstanding that's going high. That's not a great sign here. I want them to control the shares outstanding here and at least stabilize that a little bit instead of diluting the number of shares. That's not a good sign here. That's a no for me. On the positive side here, quarterly revenue that's going higher, but off late it's plateauing. As you can see here, a little bit smaller clip. That's why Wall Street does not like. They used to show a very nice clip here, but now they're kind of plateauing here. That's why Wall Street is wondering. And look, operating expense perspective, this is something they have to control again. So operating expenses are going up and up, as you can see here. I think they have to control this a little more better here and go from there. And finally, from a net income perspective, this company is not there yet. They're not showing net income yet. It's they're still losing money. So I think they have to improve that situation also. They try to show some profit earlier in June quarter here, but now they're showing some negative. So Wall Street does not like that also. So in a nutshell, these companies are doing well from a top line perspective, but bottom line, the efficiency, the rigor to run the company, that's not there yet. It looks like they're borrowing a lot of money and growing the top line, but I think they should control their expenses and go from there. So with that, let's jump in. As you look through here, we'll quickly run through this. I know it's an eye chart. We'll not look at all the details here. As you can scan through here, company has been growing nicely. Look, their market cap increased very nicely from 3.2 billion all the way to 25 billion. So that's a good significant growth here. And share price also increased very well. Think about all the low interest rate environment. You could borrow money and grow the top line. Wall Street will give you the benefit of doubt here, and stock price keeps going higher, higher, higher. And they're also growing their sales pretty in a good clip here. Look, they're growing their sales nicely. Nice 125% in last quarter. That's not bad at all. On the negative side here, they're not showing earnings per share perspective. They missed here. They missed by about 9 cents or so last quarter here. That's not a good sign here. They showed some earnings per share in 630, but they missed in latest quarter here. Wall Street does not like negative surprises. That's one of the reason stock fell off the cliff here. And then, as you can see here, from a cash perspective, they do have good amount of cash, but on the negative side, they've been increasing their debt load. I don't like this year. Look, debt was 889 million back in 2019 here, and look the way it's going higher. So I think they should control their debt here. Debt is going out of control here. I don't like the clip. The debt is going here. I think that's the biggest negative for this company. Look, debt to equity ratio. It's a huge debt to equity ratio here, 10.2. That's the biggest, in this peer group here. I want them to control the debt here. As you go into this higher interest rate environment, to finance this debt, they have to pay heavily. Right now, they're paying around 25 million to finance this debt. I think they have to control this debt level here. Otherwise, this is going to come and haunt them. You can grow the top line by borrowing money, but that can only take you so much. If you don't control your efficiency, it's going to, it's not going to be great. As you look through here, the company is losing money, free cash flow negative, as you can see here. They're improving slightly, as you see here, but still it's a negative. And gross margin perspective, it's in last 2 quarters, it's trending in the not so good direction here. You got to watch this out carefully. And from an operating margin, net margin perspective, company is not there yet. They're showing all negative, as you can see here. Things like return on equity assets show the efficiency. Company is not yet efficient when it comes to running their operations here. I think they have to improve. From the price to sales perspective, from a valuation perspective, it's not too bad, just 2.2. So, nutshell perspective, they got to control their cost here, the debt load here. That's too much here. I think they have to control their debt. They have to control their operations and show some positive, net margin projection here, or even, gross margin, show some positive trend here that can improve the company. But right now, I think they're taking on too much debt, which they should control. So with that, let's jump in here and go into some more detail. So now what we'll do is we'll look at Carvana and its peers and see how they've been doing of since last couple of years. And look, we got 2018 here. As many of you know, 2018 was the year when we had high inflation. Look, that's right here. And as you look through this year, we have Carvana on the top here, number 3. Carvana did nicely in 2018. Back then, they did not have too much debt load, but right now they do have too much debt load. And there are solid operators. As you look through here, we got CPRT here, Copart, one of my favorite company. Look, this has been a solid, consistent operator right from 2016, 2017, 2018, all the way to 2021. They've been doing nicely. In the last 1 month, they lost a little bit, as you can see here, but a consistent operator. This is a good one to buy. And we also have ABG here. ABG is Asbury Automotive. This also has been a nice play here. Look, it's been doing nicely. And CPRT, look, they got a nice financials, grade A, grade B, profitability also grade C, not too bad at all. And then as you scan through here, SAH here, Sonic Auto, $50 stock here. That's been doing nicely since 2019, even though 2018 they lost from a performance perspective. And finally, we got Lithium Motors, one of my favorite here. They've been doing pretty okay since 2019, as you see here. 2018, they did lose some money, as you can see here. And then you got a few more like here, AutoNation. They're also doing pretty well, even though they lost money in 2018 here. I mean, from a performance perspective, it's been doing pretty well off late. So in a nutshell, as you look through this, keep watching the financial, the growth and profitability. By scanning through this, looks like we have Car Guru and car parts. They're doing pretty nicely here. The numbers, the grades are pretty good here. B grade for Car Guru, A grade for car part from a finance perspective, good grade in the growth, and also good grade in the profitability. And we got Lithium Motors. It's also pretty good, as you can see here. But Carvana is struggling a little bit. Finance is D grade here, and the profitability, the F grade, they're struggling a little bit. It's a good one to buy on a pullback slowly, but I would not aggressively buy this company because it's got too much debt on their balance sheet right now. So with that, let's jump in here and look at a few more details. All right, so now what we'll do is we'll look at the long-term chart here. It's a 5-year weekly chart, as you can see here. Look, since last couple of quarters here, stock has been going down, down, down. Right now, it's about to hit its 250 week period moving average here. So we got to be watching out carefully. Huge big drop in the last few quarters here. And they had something similar back in 2020, as you can see here, during the COVID days, and they kind of recovered pretty nicely. That's why you got to be careful here. You can put on a small position here, watch, and take it from there. and go from there. So with that, let's look at a smaller chart here. This is a 1 year daily chart, as you can see here. So look, we got a quarterly earning here a while ago, back in August time frame. Since then, stock has been stalling, going down, as you can see here. So right now it's trying to see where to go. Right now, as you can see here, stock is struggling. I think this is when you can put on a small position here. I would not recommend buying too much here and go from there. Look, from a RSI perspective, right now it's a little bit negative, trying to bounce off here, completely sold off with the low RSI of 30 here. And implied vol is also around the 49-year high. I would not even recommend selling put options for this one unless you want to buy the stock. If you want to buy the stock, you could sell some put option under the stock price and make some money that way. And right now, as you see here, we got here DMI here. DMI indicates right now it's completely bearish with the red line trying to go higher, as you can see here, and blue line trying to go down. Right now it's completely bearish. That's why if you want to put on a small tracking position here, you could do that, given it's completely sold off here. And volume average on the balance volume is going negative here, telling you there is more selling pressure than buying pressure. And finally, smart money is also wondering where to go. Right now it's a little bit down here. Nobody's buying Carvana at this level. They're all waiting and watching here. So with that, let's jump in here and look at a few more details. Now let's see what options market is trying to tell us. As you look through here, we got Carvana, and Carvana is about $190, as you can see here, and it has gone as high as 376 in last 52 weeks. And keep watching the open interest here. There is some call open interest here, and right now around 190, which is the current stock price. We got around 3 open interest on the call contract side of the house here. And keep watching the put side of the house. On the put side, we got so much open interest here. In a nutshell, there are more put option traders than call option trader. That tells you folks are a little bit bearish. They're hedging, and folks are buying more put option, expecting stock will go further down. That's what is going on here. There are more put option traded than call option, which tells you folks are cautious, and they're hedging, and they're buying some protection or put options. So with that, let's jump in here and look at the option statistics. That will make it a little more clear. As you see here, we got total call options traded 1,919, total put options traded 2,782. That makes put call ratio around 1.45. That's typically a little more bearish here. More folks are buying protection and buying put options. So that's why you can be a contrarian and buy a small tracking position here. Sometimes when this happens, if stock goes higher, all these put option holders and folks who are shorted this stock will lose out, and stock will surge higher. So that might happen. It's happened to this stock earlier. That's why you could buy moderately here, expecting there could be some short squeeze type situation here, where these shorts will get squeezed and stock will go higher. This stock also carries a little bit higher short ratio, around 7% or so. And let's now jump in and look at a few more details. As you look through here, now we'll look at the performance. I think we looked at this one already. We'll jump in and look at ranking Carvana and its peers. As you look through here, we'll try to quickly rank. Look, we got all the peers of Carvana, the main ones here. Carvana is right here. As you can see here, we got number 1, Carvana. As you look through here, we'll not go through in super detail. Right now, it's got a buy rating, and stock price currently is 191, as you can see here, as of yesterday. And they got a target price of 371. There's a huge bump up from the current price here, and they're down about 49% as of now. And they got good $10 billion revenue, as you can see here. I keep watching, the growth projection for next year. They do have some nice growth projection for next year. This company has no issues with the top line growth. They do good top line growth. From a return perspective or performance perspective, in 2 years they have done 106% here. But 1 year they lost from a performance perspective negative 25. And as you look through here, this is where they have to improve. Look, as you scan through here, debt to equity here, there's a huge debt to equity ratio here, highest among all its peers. So that's one of the reasons I'm a little more cautious about this company, especially because they're losing money here, net margin negative company. And as you scan through here from a health grade, look, they got a health grade D from a finance perspective, a B from a growth, because they don't have too much issue growing here, but they have to manage their money well. That's why financial health is D here, profitability is F here, and the overall rating for this company is 18. The higher the better. This company gets the lowest rating of all these companies here. And then you got PAG here, Penske, as you know here. This is also doing pretty nicely. This one gets all C grade here. And they got a nice overall rating, which is 92, which is much better than Carvana here. And then you got Cars here. Cars gets a rating of 39, as you can see here. They're not doing great from a profitability perspective, but otherwise they're doing okay. As you look through here, Car Guru, it's a little more better operator. As you can see here, they got a B here in financial health and growth. That's a good one. And industry growth is number one. That's also good. Even CarMax is okay from a industry growth rank perspective. It's number one. And it's also okay from a profitability and financial health perspective. Gets a C grade. And then you got Lithium Motors. It's one of the solid operators, as you can see here. They get a grade of 80 here, and they also have a nice industry growth rate here. And finally, my favorite here is CPRT. This gets a nice grade here. Look, grade A in finance and grade B in growth, and industry growth rank is 1. That's a good one here. And we did not cover ABG. ABG is also doing great, as you can see here. They get a 95 rate here, and they're doing nice from an industry growth perspective, and they get a C for finance, growth, and profitability. And then finally, we got two more here. Both are doing well. ABG, I think we covered it twice, but I think SAH Sonic is also doing okay here. They're getting a profitability grade D here, but doing okay. As you can see here from a nutshell perspective, look at the overall ratings here. From an overall ratings perspective, we got Carvana, the lowest here. It's one of the not so great operator, mainly from a finance perspective and the debt load perspective. But others here, I think next one is next weakest link is Cars here, and then is CarMax. But solid operators are folks like PAG here, good one. AutoNation is a good one here, and we got Car Guru, nice one here, and even ABG is a good one, 95 overall rate here, higher the better. And we got CarPort is also great, 93 here, and we got ABG. I think we talked about it already. So in a nutshell here, Carvana has to do a better job with their debt load and their operations here. They're not there yet. I think that can haunt them in this Wall Street situation right now, given folks want to shift away from these high debt load companies and companies not making profit. That will hurt Carvana. I think that's the nutshell here. So with that, let's jump in here and look at what should I do next. As you look through here, this company is growing their top line nicely, 74% year over year from a retail units sold perspective. Revenue is also going at a nice clip, as you can see here, very good. Total gross profit here, on the other hand, it's also doing well, increased nicely. Net loss, look here, I mean, this is something negative here. They increased their net loss, here from 18 million to 68 million. So that's a huge jump here. They got to control that. And the EBITDA margin, as you see here, that also decreased. So we want margin to increase, not decrease. That's a negative one here. On the positive side here, I think there are two things. They're expanding their population coverage. That's good here. They're also doing some partnership with Root to offer insurance. That's also good here. And one thing I don't like about this company, their long-term debt is, increasing at a faster clip year over year, quarter over quarter. They're taking on more and more debt. I know they're trying to expand here, but I think they should be a little more frugal in the way they acquire debt, and be a little more nimble. And look, even after this much debt, they're even saying they want to continue to invest in the business. The moment Wall Street hears the invest word here, especially when a company is losing money, Wall Street does not like it. That's why they're sending the stock down in the current market. So what I recommend is, in a nutshell, company has got a lot of debt load here, and they got a little higher short interest. A lot of people are hedging, buying put options here. This company's stock is completely sold off here. So if you want to buy a tracking position here to really monitor what's going on, you can buy a small tracking position. I would not recommend buying a huge position here, especially because of the Wall Street situation right now, where Wall Street does not like money losing companies and huge debt load companies. That's why I recommend buying a small tracking position here. This can go higher if the shorts get squeezed, but otherwise, in the current Wall Street situation, I only recommend moderate pullback, moderate buy here on pullbacks, not a huge buy here. So, with that, thank you very much. Happy investing and trading. Please subscribe.